Hey there, I'm the Practical CFO, and welcome back to our cash flow series. We've covered a lot of ground together, from cash flow basics to building financial resilience. Let's keep pushing forward. Today, in part 5, we're going one level deeper into advanced cash flow management. Stress test your cash flow, run scenarios, identify vulnerabilities, and find breaking points. Cash flow stress testing is elegantly simple in concept, but extraordinarily in practice. Observe the live scenarios here to see the dynamics unfold. It means systematically asking one critical question: what happens to my business when things go wrong? Customer payments arriving late, equipment breaking down, supplier revenue fluctuations, and economic downturns are common. You can't predict which specific challenge will hit or exactly when, but you can be absolutely certain that challenges will hit. Stress testing prepares you for reality, not optimism, for probabilities, not possibilities, for when things break, not if they break. Here's the uncomfortable truth about how most business owners approach cash flow planning. They plan based exclusively on best-case scenarios. Assuming stable, consistent sales every month is a much safer approach than hoping for perfect timing. Expecting customers to always pay exactly on time, believing expenses will stay perfectly predictable. But here's the critical insight. Cash flow doesn't break under perfect conditions. It breaks under pressure. One unexpected expense spike spirals into taking on high interest debt because you never modeled expense volatility. Stress testing exposes weak points early, while you still have time and resources to address them. Scenario 1, revenue decline. What happens if your sales fall by 20 to 30% for 3 consecutive months? How long until you can't make payroll? Which expenses can you cut and how quickly? Do your cash buffers cover the gap? At what point do you need to take action? Scenario 2, payment delays. What if your top 3 customers all pay 30 to 60 days later than your forecast assumes? Does this create a dangerous cash gap? Can you cover obligations while waiting? Do you have credit lines to bridge the timing mismatch? Scenario 3, cost increases. Eyes by 15 to 25%. How does this compress your margins? What's your breaking point? How does this compress your margins? Can you pass cost to customers? Where can you find efficiency? What's your breaking point? Scenario 4, shock expenses. What if a $10,000 unexpected expense hits tomorrow with no warning? Can you survive? Where does this money come from? Can you absorb it without disrupting operations? How long to recover? What's the largest shock you can survive? If any one of these scenarios breaks your business model or depletes your resources critically, congratulations, you found a vulnerability that needs attention. And that's not bad news. That's extraordinarily valuable strategic intelligence while you still have time to act. No complex software needed, no expensive tools or finance degree, just practical methods that work.
Adjustment 1, reducing expected inflows by 20 to 30% to simulate revenue decline.
Adjustment 2, delaying customer payment dates by 30 to 60 days to simulate slow collections.
Adjustment 3, increasing major expense categories by 15-25% to simulate cost inflation. Adjustment 4, adding unexpected one-time expenses of varying sizes, $10,000, $25,000, and $50,000 plus. Ask yourself these diagnostic questions. How many weeks or months until cash hits zero? This tells you your actual runway under stress. Which specific expenses cause the most damage to cash position? This reveals where you're most vulnerable and least flexible. Where does financial stress appear first, and how quickly does it escalate? This shows you your early warning signs and how much reaction time you have. These answers tell you exactly where to strengthen your system, what contingencies to prepare, and which risks demand immediate attention. It doesn't panic when pressure arrives. Leaders make calm, strategic decisions because they've already planned for this scenario. It has appropriate buffers ready and accessible, not scrambling to find money, but deploying reserves that were built for exactly this purpose. It can absorb shocks without structural damage. Unexpected events create strain, but not existential crisis. It buys time to react strategically. Instead of having days to respond, you have weeks or months to adjust thoughtfully. The same principle applied to business cash flow. The same logic applies to your business cash flow. Now, here's the reality. Some of you watching this are thinking, this is great advice, but what if I'm already in trouble? What if cash is already tight and I don't have time to build buffers or run theoretical stress tests? We'll talk about what to do when cash is already tight, how to buy time, and the step-by-step playbook for pulling your business out of a cash crisis. Your action step this week, run just one stress test. And if you're closer to the edge, don't panic, watch part 6. This is the Practical CFO, helping you build cash flow systems that survive reality, not just spreadsheets. Welcome to part 6 of our cash flow recovery series. Let's explore the turnaround playbook. Click below to watch now.